But we're going to be talking now about the market construct, where all you could be looking to cash in, cash out with Devina Mehra, who's now joining us live right here on ET Now. Good morning. It's always great to have you. So thanks a lot for joining us live on this edition of The Market. Devina, I've got to ask you that, the last couple of sessions it's become quite clear there seems to be a fatigue that is setting in when it comes to the blue chips, right? Look at the HDFC twins. We saw what happened with Infosys, Reliance Industries, of course, being the aberration. What do you make of this fatigue for blue chips?
Good morning. I mean, in markets, you will always see that happening, which is, a theme that I speak about many times, that in the markets, nothing runs forever. So this whole myth that there are stocks which do well no matter what doesn't hold. I mean, you just have to look at the statistics to know that. You spoke about Hindustan Lever. I mean, that's a case in point. There was a 12-year period from 99 to about 2010 when it did nothing. I mean, both fundamentally and as a stock. So this is only a myth that, that something you classify as a blue chip will always do well for you. If you go back to what was defined as blue chips 30 years ago, 40 years ago, many of those companies would have disappeared. So that is not surprising. And of course, once you have valuations in some of them which are very high, again, you have to be wary. But then on the other hand, I would also say that there's no point looking at, for these kind of stocks, looking at a short-term movement. I mean, HDFC Bank, we have steered clear of for a while now because, even though, as you know, HDFC Bank was our original discovery in 1996. So we rode a lot of that story. But then, at a point in time, you have to take a call. So even within the banks, that has not been our pick for a while. FMCG, again, almost 2 years now, when it used to be a very hot sector. And I said, this is now the valuations are totally out of hand. And if you look at FMCG in 2021, when the markets did so well as a sector, it underperformed. And this year, again, when the markets were down, it again underperformed. So again, it's all a myth that there are certain types of stocks which always outperform, or they're defensives. And so therefore, even if they're not done as well in a run-up, they will make it up when the market goes down. But none of it holds because, ultimately you have to look at data, not at stories. That is the thing. So, I mean, our strategies actually don't change that often because just we normally look at a kind of base zero rebalancing every quarter, and we just went through that and we found we changed maybe 10-12% of our portfolio, and that's about it. So it's not as if in spite of so much news flow and so much volatility, it is not as if that the strategies change that often. So it remains probably not very different from the last time we spoke.
But Devina, what we've also seen since the last time that we spoke is somewhat of a comeback of the broader markets. I like to focus on that, but just staying a little bit with the blue chips. What started off maybe a few trading sessions back, the confidence that Reliance is now once again getting from the markets, the fact that ICICI Bank is commanding a premium now to HDFC Bank, that has never happened, right? These are quite important changes to also talk about what we're seeing when it comes to the large caps and the heavyweights.
Yeah, so as I said that in our portfolios also, for example, rather than hold HDFC Bank, we've held SBI and ICICI Bank. So that has been our bet also. Even though as financials as a whole, while we are not as low weight as we used to be, because I think after 2 years of massive underperformance, it's a little better this year, but we are still not overweight the sector. So yes, of course, you have to make the choices. That's what this business is all about. That where do you choose to be? Which is why I said that it is not as if there is any type of stocks or type of portfolio that you can just buy and say that this will do well forever. So you have to reevaluate. But then if you've chosen well, it is not even as if that you have to sort of look at everything, throw out everything every few months and start with a completely new set of numbers and companies. And right now there are many things you have to keep in mind. So unlike 2021, which was like a rising tide lifting all boats kind of market. This is not it. So, I mean, this is again something I've been saying for the last few months, that you have to be much more selective this year, because it is not even as if that just, I mean, I'm talking even fundamentals, let alone the stock prices. It's not even as if that the companies will be on a broader spectrum in the same direction, that, you know, something will do well, something will do a little better. It's not that. They're completely divergent moves in the market depending on which industry you are in, and within that industry also exactly which segment you are in, how backward and forward integrated you are. So there are like many things to be looked at just now, because, you know, for example, you know, commodities have gone up. We all know that. So if you are a seller of commodities, let us say metals or some of the basic chemicals, it is bonanza time, at least on the price front, if not the volume front. But if you are a user of those commodities, there's huge pressure on margins. I mean, you look at the wholesale price index, it crossed 14% in the last print. And even for the whole fiscal year, 21-22, it's the highest it's been there for 3 decades. I mean, I don't think we focus enough on that. And that has not all got passed on to the consumer price index, which remains less than half those levels. So there is obviously margin compression for a whole long list of sectors and companies. So you have to be very choosy this year. I mean, that clearly, I mean, large cap or below that, I mean, you have to be extremely choosy this year.
Hi, Devina. Good morning. Are you being very choosy as well when it comes to looking at the auto ancillary space? Because it clearly seems like EV is the future. We are looking at, a strong and promising growth track for the auto industry. No doubt there have been speed bumps along the way, but does that deter you?
I don't know how you come to this conclusion that, you know, the auto industry is looking that great. I mean, I see, like in two-wheelers, I think for the first time ever, and I've been tracking this space for decades, you had a situation where the volumes in two-wheelers are at a decade's low. I mean, they're lower than what they were 10 years ago. I don't think either in two-wheelers or anything else at all, you would have found that statistic. So that clearly shows me that that space is hurting. See, I mean, in many things, what you find is that there is a creamy layer which is doing well, which reflects, you know, which part of the citizens and residents are doing well. And that pattern you will see in many things. I mean, real estate, if you see high-end real estate is doing well, affordable, so-called affordable housing is not. Two-wheelers, again, doing so badly, which is actually a good indicator of people moving up the income ladder. Whereas high-end SUVs or high-end cars may be doing well. So it's a very clear kind of split in the economic numbers. If you see, for example, even, you know, tax collections are good. IT services, you see that, you know, employee costs are going up, which means, you know, people working in the organized sector and particularly in IT are doing well. But that is not true of the public at large. So EVs is a different thing altogether. Of course, see, EVs, my case has been for a while that while many new entrants have come and have quickly launched products, ultimately my bet has been on the older, the existing incumbents, because those are all smart companies. There's not, you know, smart management. It's not as if that they will let this opportunity slide. They are not the Kodaks which will think that, you know, that film-based photography will remain forever. So equivalent here, I mean, it's not as if that, you know, Bajaj Auto, for instance, has disrupted its own model so many times in history, right from, you know, stopping scooters altogether and moving completely into motorcycles, or going on such a large scale in export. So they're not the kind of company who will say electric vehicles somebody else will do and we'll continue to do what we've forever been doing. And also many of the startups have not done a very good job on the quality control front. So that, to my mind, might even spook the market a bit, that this is not a safe vehicle. So that I hope doesn't happen. And but I mean, my bet has been that we have auto companies have had good management. So there's Bajaj Auto, Maruti, etc. So I mean, I don't see them sitting out a fundamental change in the industry like that.
You know, at one time, Devina, we couldn't stop harping about pharmaceuticals, diagnostic businesses that thrust due to COVID, etc. What is your outlook now on this space as things have, resumed normalcy, and how you're looking at the entire healthcare and diagnostic space as a whole?
Healthcare and diagnostics, both globally and India, for some time, the good times are behind them. I mean, you might still find a stock or two that you like, that's different. But as a whole, that's not a sector that will, outperform greatly. That's broadly our bet, as I said, both globally and in India. So that remains. So, that's, so you have to be, as I said, you might find something which is doing well, because in pharma, etc., there are many segments. So somebody might be doing well in one or two things, but not as a whole, that sector is not particularly attractive. I mean, I would think it more like a market perform kind of sector.
Hi Devina, good morning. This is Anisha joining in the conversation as well. I wanted to zoom out a tad bit and get your perspective how India is placed versus the other emerging markets. Because even if we have seen a lot of FII outflows, India is still standing at a premium versus other emerging markets. What are you hearing on the ground from your investors and other big players? Are they looking at India favorably versus other emerging markets?
So as I have said many times on your channel, this is not something that I track, because I don't think it's very useful trying to track where foreign flows are coming, because if you look at it, it doesn't determine the market direction. It hasn't determined the market direction even when we did not have such a large domestic investor base, let alone now. But having said that, I mean, as a whole, if you look at where we think the Indian market will be this year, I think we'll continue to outperform as we did in 2021, simply because it's been a very, very long time of underperformance. So last year, our outperformance by India was, I think, number 6 in the reasonable size markets last year. But for like 5 years before that, it was number 19, 20, 24, in that range. So that outperformance will continue, which is why even in our global funds, we are slightly overweight India. So, I mean, to answer your question, yes, I think it will do a bit better than the other emerging markets, and do a bit better than overall markets also, not just emerging. But again, as I said, I mean, you have to be choosy here. That's the broad theme that I still have, because there will be many sectors that would be hurting. And also because the difference between, let's say, the US and India is that in the US, you have, yes, you have the overhang of the interest rate hikes, but the demand side is not so bad. In India, that food and fuel inflation is really will crowd out a lot of spending. So right from, shampoos to consumer durables, you are seeing, and you will see people cutting back simply because they have no choice in the household budget with everything. I mean, even wheat has gone up, which is not even an imported commodity for India. So, and that inflation is now going outside just the directly impacted sectors like food and fuel. So, I mean, that to me is the concern in India. But as I said, as a whole, it looks as if it will outperform. The concern in India, to my mind, will also be rupee depreciation this year. Again, something I've been talking about last few times I've come on your channel. That to my mind is another macro risk this year.
To hedge against that rupee depreciation, are you looking at IT in a favorable manner? And if that is true, whether you're looking at the large cap IT, mid cap IT space?
We have liked IT for a long while. In fact, we've been overweight IT right from the last quarter of 2020, I think. So because, at that time it was a sort of anti-FMCG bet, in the sense that this was also a stable industry with reasonable predictability, and also a dollar hedge, which FMCG was not, and yet the valuations were much lower. Of course, since then, a lot of the valuations have gone up. I mean, the differential narrowed. But we still continue to like it reasonably, because, as I said, our base case is that this year you will see rupee depreciation. So we have a mix of large and mid IT, again, really depending on the company fundamentals. But of course, I mean, right now you have that overhang of employee attrition and employee costs. So that's the balancing factor to the reasonable news on the revenue front.
Devina, my question is, are you looking at it as an incremental buy? Should investors be taking fresh positions given the fact the stocks have corrected? Or do you expect that this correction might last a tad bit more and there'll be better entry opportunity?
That kind of timing is difficult to do. I mean, if you want to enter, I think it would be a reasonable time to enter, because it's fine. I mean, it might also fall a little bit more. So, if you don't have positions there, then you can look at entering now. I think it's a reasonable range to enter, I would say.
And Devina, just while we're having sector rotation and we're seeing all of that, the comeback of the PSU stocks, how are you reading into all of that?
Well, I mean, as a firm, we are a little wary of PSUs. I mean, not that we don't invest at all, but in our portfolios, but I'm a little wary because there is at times unmodelable risk of what might change. So I'm a little careful investing there. So, but I mean, obviously, that has done well even among the banks. If you look last year, while the bank Nifty hugely underperformed all the broad indices, the PSU bank index did reasonably well. So, I mean, there have been opportunities, and as I said, among banks, for example, SBI has been among our major bets. So it's not as if that we avoid PSUs, but a little careful.
We're talking about PSUs and all of that. The next big event, the LIC IPO, the mega one, it is now expected as early as next week. May 2nd is a date that is also being discussed. What's your take on that upcoming IPO? Can it be India's Aramco moment?
Let's see. I mean, I have not studied it in great detail. Of course, I mean, if it does come, it also mops up a lot of liquidity from the market. So that's the other side of the IPO. But I mean, let's see how it goes.
Okay, Devina, thank you so much for joining us today. We'll let you go on that note. Appreciate your time. Okay,
Thank you. Always a pleasure.
Thank you so much.